What is up everyone? Welcome back to the channel. In today's video, I'm going to go over the basics of trading options. So I know what you're thinking. I usually do most of my videos on Amazon FBA, selling on Amazon, but I also like to share additional streams of income and other ways that I make money. And options trading, stock investing is one of them. So I want to share all of my information with you so you could do the same and not rely on just one stream of income. You always want to have a backup plan in case one stream fails or goes down, then you have other ways that you are making money. So by the end of this video, you'll know what options are and you'll be able to make your first trade. So I hope you're excited for that. But before we get into it, if you could hit that like button until it turns blue, drop a comment down below if you like this type of content, and hit the bell icon and subscribe to my channel so you could stay updated with new content every week. And just by doing that, I do a giveaway. I pick a random winner in the comment section and I give them a $100 prize or my Amazon FBA course, and I announce it at the end of every month in my video. I also want to say thank you for all the support. I finally hit 11,000 subscribers, so that's pretty big for me. So just by hitting that like button, it really does help my channel grow, and it's been growing pretty quick. But let's get into my computer right now and give you all of the information that you need to know if you want to start learning how to trade options. Let's go. All right, guys, so we are inside Robinhood. This is the platform that I use to trade options and stocks. I have a couple other platforms, but this is probably the easiest platform out there for beginners. You could trade stocks and options, and it's really easy to set up, and the interface is really simple, as you can see right here. So we are going to do an actual example of trading options. It's easier to learn it when you see someone else actually do it rather than looking at like a PowerPoint or reading like a document. This will be very straightforward. I'm not going to use any crazy terms, and you should be able to understand everything by the end of this video. So let's get into it. So first off, this is the layout. This is my portfolio right here. It gives you your history of how much money you've made or lost. And then it gives you all of your positions down here, different news articles. But we're going to try to do a option for Apple. So all I do is go right here, I type in Apple, and then I'm going to click on it right here. We are going to do an example of a call and a put. So first off, we will do a call. So I'm going to go right here to where it says trade Apple options. I'm going to click right here, and this might be kind of confusing by looking at it, but you'll understand more in a second. So right now, Apple is at 129.17, and if we want to buy a call option, meaning we think the stock price is going to go up, all we do is go right here to where it says buy, we hit buy, and then you do call, and then you pick a date at which the expiration is. So for example, I'll choose March 19th. And that's about 2 months away. So the chances are it could hit any of these prices right above it or below it. These are called in the money. It's right above 129. So that's why it's so expensive. It's $808 for one call option. Remember, one option or one contract is 100 shares. So it gives you the right to buy 100 shares of that stock. So you multiply these numbers by 100. So you're going to be paying $808 if you wanted to buy this one call option. And then if you look, the further out you go, the cheaper they get, because the chances are Apple will probably not hit 140, or even like up here, Apple won't hit 180 by March 19th. That's why the options are really cheap, but sometimes you could buy these and somehow Apple has some crazy news and they shoot up like 20 bucks. Then these options get really good and you make a ton of money pretty quick. So you could always go out of the money, or OTM. That means that they're way out of the money. The share price is 130, so the chances are Apple's not going to move that much in that short amount of time. But you could pick any date you want. You could go to like next year, 2023, but the further you go out, the more expensive they get, because Apple is a pretty good company. Chances are it's just going to keep going up for a while. It'll go down a little, but in 3 years, it's going to be way higher than 129 in most cases. So that's why right here now it's over $2,700 for one option. So I usually do about 1 to 2 months out, but you could also pick options that are way out of the money or further out and just hold them for a long time. But for this example, we're going to go to March 19th. And we are going to pick the 140. So we think it's going to go up around $10 by March 19th, and we would have to pay $450 for that one contract. So I'm going to do that. I'm going to click right here, and all you would do is hit continue, and then right here you put the amount. So one contract we would do, and then right here you can see it says 100 shares of each. It's the right to buy 100 shares of Apple. So you always multiply these numbers by 100. So you would be paying $450 for one call option, option. And basically all it is saying is you think Apple will hit 140 by March 19th, and then you have to sell before that date. So if you hold until that date and you don't do anything, your money is going to go to zero. You're not going to make any money. Even if you go over this 140 target and you make a ton of money and it shows you made $1,000, if you don't sell that option before that expiration date of March 19th, your call option is going to go to zero because you didn't execute the sell. So you have to sell them before that expiration date. And that brings me to another thing. If you hold all the way up until that expiration date, the closer you get to that date, March 19th, the more the option begins to decay. It's called Theta Decay. As it gets closer to that date, your premium is going to start to drain. And when it hits that 19th, by the end of the trading day, it's going to go to zero. So your goal is to sell it before that date. The closer it gets to it, the more it drops off pretty quick. I'll put a chart right here so you can understand Theta Decay. But you don't want to hold until the expiration, especially if you're way out of the money. You're not even close to 140. Say it's like a week away and Apple is still around 130 and you have it at 140. You could risk it and hold until the expiration date and then sell before, but chances are you're going to lose all of your money on that one call because as it gets closer to the expiration date, you begin to lose money on that premium because of Theta Decay. So that was an example of a call option. Now we're going to do a put option. So all we would do is go right here to buy, and then instead of call, we pick put, and put means you think Apple is going to drop in price, they're going to lose money, and all of a sudden their shares are going to tank. So we would say we want to buy a put option of 120. So we would pay $470 for that one contract. It's the right to buy 100 shares. So we basically think that Apple is going to drop in price or short the market. A lot of people do this to make money as the stock market's going down. People can actually make money as the stocks go down. So that's when you would buy a put. You think the company is bad and they're going to drop. So you would buy a put option. And the closer that Apple gets to 120, the more money you are going to make. So right now it's at 129. If it goes up, you are going to lose money. But if it goes down closer to 120 and even below that, you're going to make more money. And then you have to sell before that expiration date. So we still have that March 19th expiration. So say Apple hit 115 and you had that 120, your price when you sell it is going to be way higher than what you bought it for because it went past your strike price. Right here you can see the strike price. That's what you think it's going to hit. So the closer you get to that strike price, the more money you make. And then if it keeps dropping even below that, you're going to make even more money because you already hit the strike and it just keeps going. So the further down it goes, the more money you will make when you're buying a put. So those are the basics of calls and puts. Calls you think are going to go up, you hit buy call and you pick a date, and then you pick a strike price of where you think it's going to hit. The closer to the actual share price, the better the chances are that the stock will hit that price. So that's why they're more expensive, but the further you go, the cheaper they get. Again, we're on put again, so I'd have to go back to call. So they get cheaper the further out you go because the chances of Apple hitting 180 by March 19th are pretty slim, and that's why these contracts are really low because not many people are buying them. There's not much interest in them, and that brings me to the next topic. So to make sure there's actually people wanting these contracts and people are trading them, usually big companies, there's a lot of volume on them, but if you find companies like Rite Aid, there's not that much interest and nobody wants to buy the contract, so you'll see zero. To see how much volume and interest in these contracts, all you have to do is click on the actual price. So say we want to buy Apple 140 calls, I have it on buy call. And then we're going to go right here to 140. We're going to click on it. So right here, you can see the interest is high, and that is good because chances are someone will buy and sell the contract. But if this number is like 0 to 20, that means there's not that much interest, and your call option or put option might not fill because no one wants to buy them. So now you have an open order because no one wants to buy that contract and you can't buy or sell one. So you always want to make sure that there's open interest and volume on that stock. Usually companies like Apple or other companies like Amazon or Visa or PayPal, they usually have high interest and high volume, but if you find some of these other companies that have like low volume on them, they're not that popular like Rite Aid or other companies, they might not have that many contracts, and it's going to be hard to buy and sell options on those companies. And also the further you go out, the less interest there is. So if we go way out of the money at like $230, we think Apple is going to hit $230 in a little under 2 months, which is pretty much impossible. There's no chance. But if you go here, you can see there's zero interest. So when you go to buy a call on this one right here at 230, it's not going to fill because there is no interest. There's barely any volume, and nobody wants to buy these contracts because the chances are Apple will never hit 230 in a little under 2 months. So that's why you go closer to the actual share price. And if you go like this one, like 135, you could see the open interest is way higher, the volume is way higher. So you want to make sure there's volume and open interest, and that means that people will actually buy and sell call options and you can actually fill those orders. But if there is zero volume and zero interest, and it won't fill because there is nobody that wants to buy or sell the contract. So you always want to make sure that there's interest and volume, and that is just one other thing to look at when you're trading options. So just for another example, I did Rite Aid, and I'm going to show you the difference between Apple and Rite Aid. So we are on Rite Aid, we did buy, call, and then we're going to pick, let's say, February 5th. That's about a week out. So right now, Rite Aid is at $18.55. So if we go to like, let's see, $25, let me click on it. We could see that the interest is at 3 and the volume is at 0. So if you tried to buy this call option, this $25 call option for next week, it would probably not fill. It's really cheap, but it probably won't fill because nobody wants to buy the contract. No one is selling contracts for this actual call price. So your order would not fill. You could try to place it, but it probably won't fill because there is no interest and no volume. So one of the most active ETFs or exchange traded funds, it tracks the S&P, which is like the whole market, is SPY, and this is it right here. So a lot of people trade options on SPY because the volatility is really low. That means it doesn't jump up a lot and jump down a lot. It's always only moving by a couple percentage and it doesn't move much. So for an example, I pulled it up right here. I hit buy call. And then if you look right here, look at that interest. Over 140,000 people are interested in these contracts, and there's over 170,000 contracts moving around. And then look at that volatility. The lower it is, the less it moves. So this is only 16%. Pretty much any company with under 50%, that means it's not going to jump up by like 20% in one day and drop by 50%. It's more stable and it doesn't move as much as other companies, where if you look at like Rite Aid, it's probably around 100 to 200 implied volatility. And that means that the stock price moves a lot quicker and faster because it's really volatile. That means it's moving a lot. So one other thing I wanted to show you was an actual call that I have. So I'm going to go right here. I have this one right here. It is ExxonMobil. So I'm going to click on it, and I've done pretty well on this one call. I only bought one, but I bought it way out of the money, far out, but it's been getting close to that strike price of $50. It's actually above it right now. It's at $50.58. But I bought this last year around November, and it doesn't expire until 2022. But you can see right here, I've made $412 on this one call option. But if I was to actually buy the stock, I would make way less than what I've made from this one call option. So you can see the power of it. Even though ExxonMobil's gone up like maybe 15%, this call option or this contract has gone up over 184%. So that's why I like trading options more than stocks, because you can make a lot more money. And the cool thing is I could hold this for another year, and chances are ExxonMobil is going to keep going up. And I bought ExxonMobil because the whole coronavirus pandemic, it dropped off by a lot, and I bought it back here in November, so before this big run, and it was really cheap. I saw it down like 50%. So I thought in the next year and a half, it's probably going to come back to where it used to be. So I'm going to pull it up right here real quick so you can see what it's actually done. So I typed in XOM, which is ExxonMobil, and then I'll bring it up right here. So over here, when coronavirus hit, you can see it dropped off. It was like in the 60s. It went all the way down to in the low 30s. And then it shot back up here, and then it dropped back down. I bought it in November. So it was around $35, and now we are at $50. So it's only gone up $15. But when you have a contract like what I have, because now people want to buy this contract because it's really close to $50, it's in the money because it's really close. And Exxon is $50.58. So people want to buy these contracts because they still have a lot of time left, and it could keep going up, because if you look at the overall chart, it is still down from where it was before the pandemic. So there's still a lot more room to run. I think it's going to hit around 60 or even go back above it once everything is over and back to normal, hopefully before 2022, because that's when my call expires. But I'm going to have to sell this at some point before that expiration date, or I will lose all of that money. But those are the basics of calls and puts and what to look for when you're buying them. You want to make sure there's interest, there's volume. You're not way out of the money and think that the stock's going to jump $100 in 1 week, because chances are it is not going to jump $100 in a week, and you're going to lose whatever that call option was, how much you spent on it. And just remember, you do have to sell the option before it expires. If you're above the money and you made a ton of money but you never hit sell, then you are going to lose that money because options will expire worthless if you don't sell them. So the closer it gets to that expiration date, just remember you got to sell. You lose more as it gets closer to the expiration date. Remember theta, and that means that you want to sell when you're not too close to that date, but you want to make sure that you're making money. If you're losing a ton of money right from the start, you might want to hold it for another week, but you never want to hold it all the way until expiration unless there's some kind of miracle and the whole market jumps one day and you made some money back, but you still want to sell before that expiration date. All right, so I'm going to be doing more videos on options trading, but those are the basics and all you really need to know to start learning how to trade options. Go out there and look at different companies. Stick with companies that you know. Don't go out there and look for penny stocks and think they're going to raise up because they're so cheap. You want to go with like companies like Visa or Apple and Microsoft, all these big companies, because they're not that volatile and you could actually make some decent money if you know like their background and they're actually good companies. But that is it for this video. If you want to join my options trading Discord, check out the link down below. I also have the Robinhood link down below, but that is it. I will see you in the next video. Goodbye.